I'm pleased to say we've got Simon Gurgle with us today, who is the portfolio manager for Merchants Trust, and he's also the chief investment officer for UK equities for Allianz. And welcome, Simon. Look forward to hearing your presentation, and I shall pick up at the end and join you for the Q&A.
Thank you, Mike, and good afternoon, everybody. And I'm delighted to be speaking to so many shareholders and so many non-shareholders as well. So a good combination, 55% shareholders. As Mike said, hopefully you can see my screen now. I'm going to be talking about the Merchants Trust, which I'm the manager of, and I'm taking questions. So without further ado, let's move straight on to what we're going to cover. I'm going to give a quick overview of the Merchants Trust. I'm going to talk about our investment process, talk about how we are positioning the portfolio and how we think about the outlook, and then say a little bit about dividends and performance, which are two very important aspects of the trust, before concluding and taking questions. In terms of the overview, I mean, the first thing to say is we think the UK is a great place to invest. We have some of the strongest standards of corporate governance in the world and stewardship. And the Merchants Trust is predominantly invested in UK equities. We have a yield just under 5%. We are an AIC dividend hero. We have grown the dividend every year for 40 years, and we have significant reserves. That's the first point. Secondly, we have a strong performance track record, despite that high yield. And that's been delivered with high conviction, active stock selection approach. And by active, I mean, we don't just have big positions in shares, but we do move them around as markets change. And we are value driven as well, which has been a bit of a headwind for most of the last decade. But despite that, we've delivered a very strong track record. And the third thing is we have one of the lowest fee scales in the sector, and a really experienced independent board of directors who are there to look after shareholders. And I'm very happy to take any questions about that as well. The objective is to deliver a high and rising income stream and to deliver a good total return, investing predominantly in large cap UK equities. The assets are just under 900 million, dividend yield, as I say, nearly 5%. And we've been trading at a small premium to assets for most of the last year or two. And gearing is around about 14%. Gearing is the ability to borrow to invest in the portfolio. I'll come back to that later, but we have about 14% gearing, which is somewhere in the bottom half of our long-term range that the board has set out. So moving on to the investment process. Fundamentally, we are value investors. It's quite a simple process. The idea is we think markets ultimately are driven by fear and greed. Individual shares, individual assets move a lot in price. And when people are optimistic or greedy, shares can get overvalued. And when people are pessimistic or cautious, shares can get undervalued. And if you are fairly rigorous in your process, if you can exploit this, if you can find companies that are trading below what they're fundamentally worth, there is the ability to outperform. And there's a lot of statistical evidence that can support that. But clearly, we don't just buy every single company that is lowly priced. There's a lot more to it than that. But that really underpins our investment process. We think that the inefficiency of market, the fear and greed are factors that are going to carry on in the long term, and that we can exploit that. The way we do that has two aspects. One is we do it with conviction. We find companies we believe in and we build large positions. We tend to be contrarian. In order to find companies that are really good businesses that are cheap, they tend to be out of favor for a reason. So we inevitably find ourselves buying companies that for some reason are out of favor, or maybe a bit contrarian. And you have to be a bit opportunistic with this approach. Companies don't necessarily stay cheap for long periods of time. So we have to look for opportunities in markets. And last year was a great example. There were lots of opportunities in quite a volatile environment. The other thing to think about very carefully is risk. When you're buying companies that look cheap, you've got to think very carefully about what could go wrong and the downside risk. We think about risk in three levels at the company level. We think about fundamental operating risk. So what could go wrong in the business and the operations? We think about financial risk. How much leverage, how much debt does a business have, and could it get into trouble because of that? And we think about valuation risk, which is a risk that many people don't talk about. But if you buy a company at a high valuation, you can lose a lot of money, even if nothing really goes wrong in the business. So those three risks are really important. And then at the portfolio level, we think about other types of risk, which I'll come back to, but sector risk, cyclical risk, that type of issue, which you think about at the overall portfolio rather than individual companies. What about income? So we are looking to buy high yielding companies. Now, you might think if you buy companies with a high yield, you get a worse return because you're getting more money out today, so you might get less money long term. Historically, that's not actually the case. So we've got a study here on the right-hand side of this page from Farmer and French, a very well-known study, which looks at the US market. And the reason we look at the US market is because the data goes back a lot further. We can look over 9 decades in the US market. And for 8 of those decades, if you'd bought on average the higher yielding shares and sold the lower yielding shares, you'd have outperformed for 8 of those 9 decades. And on average, including the last decade, which is more difficult, you've delivered a 1% plus outperformance. That's quite a lot, actually, over 9 decades. It may not sound a lot. The one period that didn't work was the decade up until late 2021, where you saw, in particular, very low interest rates, in some cases negative interest rates, and a real boom in the valuation of high growth companies with limited profits and limited dividends. It was a difficult environment for high yielding shareholders, but generally, high yield investing has worked quite well. Now, we don't just buy all the high yielding shares, we're very selective. But the way we think about it is we try to start with the universe of shares that yield in line with the market or above. We limit ourselves, if you like, to high yielding shares. But yield is not the driver of our stock selection. In fact, we're always thinking about total return. We're thinking about making money in these shares. So it's a really important distinction. We do limit ourselves to companies with a decent yield today or in the future, but we look for companies where we think we can make money. And the yield doesn't drive the decision either to buy or sell. In fact, if a company's share price goes up and the yield drops, we don't automatically sell it. We think always about, we're a bit more pragmatic. We think about the total return we can get. So what do we look for? There's really 3 things we look for in a company. And most of the analysis is on 2 of them. So the fundamentals of a business really are, what's the competitive position of this company? How strong is its business model? How attractive is the industry it's in? How strong is the financial position? How good is the governance around that? How are the board motivated? How are the executive motivated? And we also bring in the environmental, social, and governance factors, particularly into this area, although they come into other areas as well. And we're trying to build a picture. We're trying to buy fundamentally strong businesses if we can. The second thing we think about is valuation. We're looking for companies that are cheap compared to history or cheap compared to other companies in the market or their sector. And particularly, we look at cash flow. Cash tends to be, in our view, the best measure of underlying performance, and cash ultimately pays returns to shareholders. So we think about cash. We do look at other measures as well. Not all companies generate cash, but we do. But cash, I would say, is the prime measure we look at. And then the third thing is we've got strong businesses that we think are cheap. We sort of say, what's going to change? We're looking at the external environment. Ideally, we want companies where the external environment is positive. So long-term themes that are supporting the business, like demographic changes, digital transition changes, environmental changes, or sometimes shorter-term themes like a recovery in defense spending we're seeing at the moment, or where we are in the economic cycle can come in. There may be times when we look at companies with negative factors, but if there are, we want to really understand those. And in particular, we're trying to avoid value traps. Value traps are companies that look cheap, but they have a fundamental problem or a theme that's going against them over time and eroding the business model, and where the fair value of the company keeps declining. So we are prepared to look at companies with difficult themes, but we need to really understand them and try to avoid those that are going to seriously damage the value of the business. I'll give you an example in a minute, but just to dig into ESG a bit more, so environmental, social, and governance, we only exclude a relatively few areas from a sort of top-down exclusion policy. Companies with a lot of exposure to coal or controversial weapons will exclude. But generally, we want to understand risks. We want to dig in and understand environmental risks, social risks. And if a company does have a high exposure to one of these risks, then we have to think very carefully about it, and the fund managers have to actually explain internally why we are willing to invest in the company. Well, either we don't own it, or if we do want to own it, we have to explain internally why we want to own the company despite this particular risk. So we think about this very hard, and then we engage with businesses on these issues and other issues to try and improve practice and improve performance. So to give you an example of a company we added last year, Grafton is a building materials company. It has a really strong position in Ireland. It has the leading building merchants business, but also the leading DIY company in Ireland. It also owns in the UK. It owns the Selco brand. You may know the Selco builders merchants. And so Ireland and the UK are its biggest areas, but it's got activities in Finland, the Netherlands, and elsewhere. It's got a good record of allocating capital and buying businesses elsewhere and building the company. It makes good returns, and it's been sitting on a lot of cash after a big disposal in the UK. So it's a strong business with good market positions. The valuation when we bought it last year was quite depressed. The shares had almost halved over the previous year. It was sitting on a lot of cash. It's still about 25% of the market cap, but it was even more then. And so it was cheap. And the third thing is, clearly the economy is heading into a slowdown, but long term we see strong demand for housing and housing related products. The Irish economy is likely to be more resilient than the UK economy because of where they are in the housing cycle, which gives support to it. And I think there's also opportunities to consolidate the building products market, the building materials market. And so there are a number of themes that are helpful, albeit one of them, which is the economic theme, is more difficult. So that's how we think about the business fundamentals, the valuation, and the thematic outlook. Putting that together, so that's our stock selection. If we then think about the entire process, we start with our ideas generation, looking for companies, as I say, with a decent yield, but across the UK and selectively across European shares, but that's about 5% of our portfolio. We then look at what I say, the stock selection approach, fundamentals, themes, valuations. We'll then try to build a portfolio of about 40 to 60 holdings. We want to have enough to diversify the portfolio, but also enough conviction in each individual company that it can make a difference. We have a high active share, so we are very different to the benchmark. And we think a lot about risk management. At the portfolio level, we think about exposure to different sectors, to cyclicals versus defensives. In the UK, you've got to think a lot about domestic companies versus international, because so much of the earnings of the UK are international. We think about those types of risks. And the sell discipline is also very important. We would sell a share if the valuation gets towards or at our fair value. In practice, we tend to be quite gradual. We tend to be reducing shares into strength and building them up into weakness. If the investment case changes, we are very rigorous about reassessing and trying to ascertain whether we still have confidence in that investment case. And sometimes we'll sell a share because there are better opportunities elsewhere. We may still like that business. We might find better alternatives. And that altogether builds the portfolio. So I'm now going to turn to outlook and positioning. I would say when I think about the outlook, we are predominantly bottom-up investors. We're predominantly finding attractive companies at good valuations. But we do have to think about that in context. So we are at the moment in a very challenging economic environment. There is a risk of a recession. Interest rates have been rising. And companies have actually got a lot of problems they're dealing with. Consumer demand or end market demand is a clear risk. We're seeing rising interest rates affecting companies as well and the cost of their debt. We're seeing deglobalization. We've seen for many years globalization, but now companies, because of what's happened in Eastern Europe and what's happened in China and Asia and through the COVID pandemic, companies are trying to bring their production closer to home. They're building up extra production, extra inventories, which is building up costs, probably impacts their margins as well. So deglobalization is likely to be a theme for quite a while. And then labor costs, clearly we know, are rising. And in fact, there's still a shortage of labor despite the potential slowdown in the economy. Many companies are struggling to get labor. So there's a lot of different issues companies are dealing with. However, on the slightly more positive side, we have seen commodity costs roll over. So energy costs are coming down. and we're now annualizing the big spike a year ago. Unemployment remains low. So the flip side of that is that demand is still decent in the economy. For people have got jobs and are getting decent wage rises. And of course, bond yields may well have peaked. I mean, we saw in the autumn, particularly in the UK, bond yields spike up to very high levels compared to what we've been used to. And they're now coming down again. Mortgage costs are already coming down from where they got to in September, October. I think if we look at markets, the UK market is pricing in a lot of bad news. And the chart on the bottom left shows our strategies team's analysis of different asset classes and whether they're cheap or expensive compared to history. And it may be hard to see on the screen, but they believe UK equities are one of the cheaper asset classes and certainly cheap compared to its history, compared to most other areas that look pretty fully valued. And one of the reasons for this is we've seen a lot of outflows from the UK, particularly last year. And you can see on the chart that outflows have been going on for quite a long time. Outflows of investors from the UK. Really ever since Brexit, the UK has been under a bit of a cloud. And so UK shares have got pretty cheap compared to elsewhere. On top of that, cyclical shares are extremely cheap because they're pricing in a lot of risk. And so there's a great opportunity. We're seeing this big dispersion of valuations in the market, and that's creating a lot of opportunities. Just to put a bit of color on that, on this chart on the left-hand side, you can see the UK valuation compared to Europe. It has recovered a bit in the last 12 months. Last year, the UK was one of the better performing markets, but it's still very cheap on a long-term basis compared to Europe. And on the right-hand side, you can see the dispersion of valuation. The range of valuations in the market is still very wide indeed. And that is a great environment for picking stocks and finding bargains. If I talk about some of the trades in the last 12 months, well, I won't go into details, but this is just a list of the new companies in the portfolio and the disposals over the last 12 months. And the first thing you can see is there's a lot of activity. Although we've only got about 50 companies, 53 in the portfolio at last count, we have actually been pretty active in finding new ideas. Early in the year last year, we were finding ideas, I would say, across the market, both in more defensive companies like Unilever, Haleon, those type of businesses, but also cyclicals. I think in the second half of the year, we found more opportunities amongst cyclical companies. Companies like Grafton, like CRH, like NatWest, and so on. On the right-hand side, the sales, a wide range of reasons for selling shares. In some cases, like HomeServe, there was a bid. Case of Relex, the valuation got to our where we thought was full value. And then in others like ITV, we think the investment case changed and we sold it. So quite a wide range of activity, but as you can see, as I say, we are active investors. One other point to say on the overall portfolio, this chart, sorry, it's a bit complicated for those who haven't seen it before. We break down the stock market into buckets. So on the right-hand side, there's about 5% of the stock market on a price earnings ratio of more than 24. That means you're paying £24 for every pound of profit in 5% of the companies in the stock market. And you can see also in those lighter blue bars, there's a big chunk, maybe a quarter of the market on quite high valuations compared to the rest. If you look at our portfolio in the dark blue, we don't have anything in the higher valuation end, and we've got a lot in the lower valuation end. So we are quite skewed to lowly valued companies. We are value investors, and this chart sort of proves that or demonstrates that. The other thing that's unusual is the market does not have a normal bell curve shaped distribution. You would expect normally to have most valuations in the middle and relatively little at either end. Actually, it's the opposite. We've got a lot of valuations in the market at either end of the spectrum and not much in the middle, which is quite unusual. Our portfolio is a bit more normal, but actually still quite orientated towards the lower end. Moving on, some of the themes, I won't go, again, there's a lot of stocks here, and I won't dwell on this, but just to say some of the themes in the portfolio, you might be surprised to see for a value investor. So digital economy, we've got companies like S3, which we think benefit from digital trends. Pretty much every company we speak to is looking to recruit data analysts, AI specialists. Companies are completely transforming their businesses for the digital world, for the computer age. And a company like S3, which provides people flexible staff, particularly in the IT area, but also in life sciences, in engineering, they're seeing very strong demand growth on a structural basis as companies look to bring in flexible staff on contracts to rebuild their businesses and reposition them for the digital age. And yet that company has historically been pretty modestly priced. Another theme we like, if we can get it, is uncorrelated exposure, uncorrelated cyclical. So clearly there are risks in the economy, but if you can find something that's not correlated to that, like the reinsurance sector, which has its own cycle where prices are rising very fast, that can be quite attractive. That's just another theme. So you can see different themes here, different ideas, different types of companies. This is not the entire portfolio, but it covers quite a lot of the portfolio. And I'm happy to take questions on that as well. I talked about thinking about the distribution of the company, the exposure to cyclical companies, defensive. By cyclical, we mean companies that are linked into the economy and go up and down, the prospects go up and down with the economy. By defensive, we mean companies that are more resilient, like food producers or utilities. On this chart, what you can see broadly is about 40% of our portfolio at the bottom is in more defensive companies. We're not a million miles away from the overall market on the right-hand side. We think we are a bit more cyclical, have a bit less in cyclical, in defensives. And actually, we've become more cyclical through last year. It may look like those weightings haven't changed very much in the last 12 months, but actually, because defenses were performing quite well, the defensive part of the market was going up. So in order for our defensive exposure to go down, we've actually been selling defenses, reducing exposure and buying more cyclical exposure. Again, happy to take questions on that. This page, really, I won't dwell on, but it just shows the largest positions in the fund, the top 20, some of the sector positions. It shows that we've got 57% of the fund in FTSE 100 companies. So we are predominantly large cap, but we do have a large exposure to mid cap and also international, about 5% in it says 8%, but it's really about 5% in non-UK listed companies. Of the top 10 holdings, many of those names will be very familiar, but some might not be so familiar. Companies like DCC, IG Group, and certainly in the top 20, there's many companies that are not in a lot of other income funds, or certainly not to the same extent as ours. So we are quite differentiated in our portfolio, and we do move it around quite a lot. As I say, I'm happy to come back to that on questioning, but I just want to give you a quick run through. So the final area to talk about is dividends and performance. Yield income is really important to merchants. We have grown the dividend for 40 years, as I said at the beginning. What you've seen in the market on the left-hand side of this chart is we saw a sharp drop in dividends during the pandemic, something like a drop of 1/3 from peak to trough, and then a very sharp recovery in 2021, and that carried on to 2022. And we saw something very similar at Merchants Trust. Our income fell very heavily in 2021. This is the income received in the portfolio. It then rebounded very strongly in 2022 and has continued. Sorry. Our 2021 year is really calendar 21 because our year end is January the following year. So in calendar 21, in calendar 20 during the pandemic, our fiscal 21, the income fell and then recovered in 2021, which is our fiscal 2022, and then continued in last year, which is calendar 2022, or the current year, fiscal 23, which is year's just finished. So in the first half of the year that's just finished, our income actually got very much back. Our earnings per share got very much back to where they were, where it was back in the before the pandemic. So we're on an encouraging trend, and we're continuing to see many dividends come back. I mean, BP today raised their dividend by about another 10%. So you are seeing income still coming through in general, although there are risks to that. If you then zoom out a little bit and look overall at Merchants Trust, this shows our dividends for the last 40 years, and they've grown every year, and that's the number on top of each bar. But we also show in colour whether the directors have used reserves. Oh, sorry, I should go back a bit. With investment trusts, the directors can put money away in reserves in difficult years and draw on those reserves in good years. And they did this, if you like, before the financial crisis, 2007, 2008. The directors put a lot of money away into reserves in the green bars, and then they drew on those reserves in 2010, 2011 to keep paying a growing dividend in tough times. We've done the same thing. The directors have done the same thing through the pandemic. We put a lot of money away, as it happens in 2019, 2020, and then we drew on those reserves in 21, 22, and we're coming out of that period now. I can't give a forecast for the year that's just finished, but the trends have been improving, as I said, and we still have significant reserves. The company had 16 pence of earnings reserves per share at the beginning of last financial year, which is around about half of the cost of an annual dividend. So we're on a good trend there. The other objective, as well as paying a high yield, is to deliver a good performance. And we're delighted with the performance we've delivered over the last 10 years. You can see here the blue lines are the net asset value and the share price total return. And it's been much, much stronger than the return on the benchmark. But there is an element of gearing borrowing, which distorts the numbers. So if you then look at the portfolio return in the bottom chart, if you look over 5 years, 10 years, we've delivered strong outperformance. Over 5 years, we've outperformed the stock market by about 3% per annum. Over 10 years, by nearly 2% per annum. This, to remind you, has been in a difficult environment for value investing. Our style of investing, buying cheap companies, has been out of favor. So we've been particularly good at avoiding some of the worst areas and picking companies that can still do well despite that headwind. We think we might be in a better environment now. Certainly the last 12, 18 months has been a better environment for value investing. And if so, that gives us a bit more of a tailwind for our style. But we're still very pleased with the numbers we've delivered despite that headwind. Finally, on gearing, investment trusts can borrow money. And the reason that they might do that, and we do it, is firstly, if you can get a better return than your cost of debt, then you can enhance shareholder returns. So our cost of debt is around about 4%. If we can get a return of 5% in terms of yield, but maybe more overall, then we can enhance the total return for shareholders over the long term. The second thing is, because of the way we structure the trust and the costs in the trust, we can enhance the income by borrowing as well. That's a bit more technical. Of course, gearing or borrowing does raise the risk profile. So in volatile periods, we will be more volatile than the market. And when markets go down, to state the obvious, our asset value and our share price are likely to fall faster than the market as well. So shareholders need to be aware of that. That's the cost of having gearing. In terms of the amount of gearing, if you go back 5 or 6 years ago, we had some very expensive debt. The average cost was 8.5%, taken out in the late 80s, and had 111 million of debt, long-term debentures. We've completely restructured the debt over the last 5 or 6 years. We now have 110 million of debt, 109 million of debt, with an average cost which is halved to 4.3%, and gearing is about 14%. The gearing range, target range, is between 10 and 25%, and we are in the bottom half of that range. We have paid down debt pre-pandemic. The directors took down the debt from 21 to 15%, which was quite a good decision in the event because of the pandemic. And then actually they rebuilt that debt. They drew down the debt last November to go back to 109 million and to take gearing back up to 15%. Again, happy to take questions on gearing, but that's the last slide in the real presentation. So just to conclude, we have a high yield, one of the highest in the sector. We've raised the dividend every year for 40 years, and that's a significant objective. But despite paying a high yield on that income objective, we have delivered very strong returns for shareholders, beaten the benchmark over a long period of time through our active value-driven approach. And we have a fee scale of 35 basis points on gross assets, about 0.55% total ongoing charge, and an experienced board of directors. So with that, I'm happy to take questions. I'll stop sharing for the moment, but I may share if relevant.
Thank you, Simon. Thanks for taking us through the presentation. We've had a few questions come in while you've been talking. Just a reminder to everybody listening, if you've got any questions to ask, please do click on the Q&A box and type away, or vote for one of the questions that's already in front of you. First question here is, has Shell always been one of your top 5 holdings? And if not, can you give us a sense of how you have traded in and out of Shell and why?
Yeah, it's a good question. I don't think it has been top 5, but I'm not totally sure. But what we have done is we've reduced it and reduced exposure to the energy sector after periods of good performance. So, for example, in around about 2017, 2018, we had a bit less in the energy sector because we had a good run and valuations didn't look so attractive, and we took profits. Then when the sector got very out of favor again during the pandemic, and if you may remember, Shell had that sort of period where they had to cut the dividend by 2/3. They were losing money this time 3 years ago now. They were losing a lot of money. But we were getting more and more interested in the sector because it's not just about the valuation of the company, but it's also about the behavior of the industry. Really, for the last 5, 6, 7, maybe even 8 years, the industry, because of environmental pressure, has been cutting back on investment, and actually because of low returns as well, has been cutting back on investment. So if you go back before 2015, the big oil companies around the world were investing about $800 billion a year on capex, and then that fell to, well, sorry, the whole industry, including the national companies, that fell to about 400 billion in about 2015 when the oil price had fallen and returns started to come down, and that level of investment has stayed pretty constant since then. We haven't seen a big increase. That means there's less reserves being brought through, less drilling going on, less new supply, and supply has been getting gradually tighter and tighter. So even during the pandemic, we were getting more interested in the fundamentals of the industry because supply is quite tight. And as demand recovered, of course, the energy price has gone up. Even well before the invasion of Ukraine by Russia, you were seeing energy prices recovering. And this is quite, for an investor, this is quite a healthy environment because there is limited capacity coming on stream. Demand for oil, but particularly gas, is growing, and gas demand is likely to continue to grow significantly for many years, particularly as countries like China and India want to decarbonize, want to replace coal generation with gas generation. Demand for gas and liquid natural gas is likely to continue to rise. And Shell and BP have big gas exposure these days. So we see good outlook, and we built up positions again in 2020, 2021. And we've taken some profits in the last 12 months, but we still see good value. And we're seeing very strong results from the oil companies, or which should call them energy companies now today, because they're leading the transition. So, sorry, it's a long answer. I don't think it's always been in the top 5, but it's been quite close if it hasn't in the last few years. But certainly we have moved that position around from time to time.
Okay, thank you. Looking forward in this volatile environment, what do you believe are the main changes you may need to make to the portfolio?
Well, that's a good question. It's hard to know because a lot of it depends on what happens in markets, not just in economies, but in stock markets. So, as I say, last year we were building up cyclical exposure. If cyclical shares continue to rise, which they have been doing in the last couple of months, and continue to rally, we may start to take some profits. And we've taken a little bit. We might start to take profits in them and look to go back into more defensive areas if those valuations are more interesting. But it's very hard to know where the opportunities are going to arise. We continue to look across the market for new opportunities. We've done a lot of work on the retail sector, for example. But it's always a difficult question to answer where we're going to go next, because it depends on where the opportunities are, and if it also depends on the way the economy goes, and if the economy starts to recover quickly, then those cyclical shares might well get more fully valued quicker than we expect. So it's really impossible to answer, right, I'm afraid. I'm sorry.
Okay. Are there sort of, just as a subsidiary to that, are there particularly any particular trigger points you are looking for that encourage you to switch out of defensive and into cyclical when you're looking at individual stocks? Are you doing that at a sort of market level, a micro company level, or a macro level? What are you looking for?
That's a good question. It's both, actually. So at the micro level, clearly, when you're buying cyclical stocks, you've got to think very hard about the balance sheet. If we're going, particularly if you're heading into a downturn, and we could still be heading to a very severe downturn because of the cost of living issues and because of some of the pressures on businesses. So you've got to think a lot about the balance sheet, and then you've got to think, well, but try and look through the short-term pain and say, what does this company look like in the long term, and try and build confidence. I think at the macro level, though, what we were seeing last autumn is it felt like peak pessimism. People were focused on, we had that period where the front page news, the headlines on the news in the evening was all about the cost of living, the mortgage rates, the gas price, the headline news where the European gas price is, which is not something that would normally be in the headlines. When Liz Truss became Prime Minister and Kwasi Kwarteng had his mini budget statement, mortgage rates went to 6%, and this was all in the front and center of the news. But even at that point, it was clear that energy prices were probably going to roll over. Certainly the oil price had already rolled over. Gas price spikes were not going to be sustainable because ultimately demand will be destroyed. Demand has been a lot weaker this year than might have been previously expected, and supply was responding. So we felt that a lot of the bad news was being priced in, that bond yields would start to come down, and central banks were taking action to raise it. And so it felt very much like we were at peak pessimism, and that gave us extra confidence to buy more cyclical shares because of because things were likely to start to get better. Maybe not immediately, but certainly on a 6 to 12 month view. And falling interest rate expectations, falling bond yield are very powerful for more cyclical parts of the market. And so the market tends to look ahead. The stock market, well before the peak in inflation and the peak in interest rates, cyclical shares got sold off quite early in the Ukraine invasion. And so we were looking ahead and thinking things might get better. So it was both micro and macro. And at the same time, the defensive shares were looking a bit more fully priced. So it was a natural to take money out of them.
Okay, thank you. Next one up, a little bit of a testing one. Can you confirm you will continue to invest in oil and tobacco if they offer the best opportunities for an attractive return?
Well, I would say we are balancing returns with risks. So it's about risk-adjusted return, and there are certainly no plans to rule out investing in either of those sectors. I think they are quite different though. So I think if you look at the energy transition, the big concern from some, I think what might be behind this is the question about ESG.
Yeah.
I think the question for many energy investors is, should you avoid investing in fossil fuel companies? And people like Sir David Attenborough have told people they should take their pension fund investments out of energy companies. I fundamentally disagree with that. I think that the big energy companies are actually leading the energy transition, and we need the resources they've got to be deployed to building, whether it's renewable power, to hydrogen, whether it's EV charging in petrol station forecourts, and BP's announcement today, they're going to spend a lot more money on energy transition investments. I think it's a very powerful endorsement of that. These companies have the skills, they have people, engineers, they have the money, they have resources, they understand about hedging power and trading commodities. They have people who understand how to build things on the seabed or floating platforms in the sea, how to connect, to decarbonize, to pump carbon under the ocean. If anyone's going to do that, it's the big energy companies. So I think they have a really valid role in the energy transition. So disinvesting from them, I don't think will achieve anything. It might actually be counterproductive. So if they offer good value and they have a positive transition story, I see no reason why we shouldn't continue to invest in the big energy companies. I think tobacco, you've got to be a bit more nuanced. I think the products they sell are generally, known to be harmful. And so you have to balance the fact that fewer people are smoking every year and the harm that products are doing with the potential for these companies to, not only offer good financial returns, but actually to improve what they're doing, to invest in less harmful products, to focus on the harm they're potentially doing in the environment and get their farmers to invest in a more sustainable way, to actually think about the way they're treating the tobacco farmers in terms of social policy and the harm from green tobacco sickness, which is a harm. There's a lot of harm potentially for children working in tobacco fields. We want to see the industry outlaw child labor. Often it's the farmers' children that work in tobacco fields or tobacco farms. And so there's a lot the industry can do to improve its sustainability. But we are also very conscious of the risk of a declining product, and we do price that in. So we would expect tobacco companies to trade at a very big discount. But if they are trading at an extreme discount because of concerns about the harm that the products do and environmental ESG concerns, that can be an opportunity, and it has been an opportunity in the last couple of years, and the tobacco companies have given good returns. So I won't say we'd always invest in them if they give good returns, but if we think the returns offset the risks in the investment, then certainly at the moment we are not precluded from investing in those companies. But shareholders have a vote. We are a public company. If a lot of shareholders think we shouldn't be investing in tobacco and they make that case to the board will consider it. But it would have an implication potentially for income and returns, and that's something that needs to be taken into account. So it's a long answer, I'm afraid, but I hope that's covered it. If there's a subsequent question, please come back.
Okay, thank you. Well, I was going to say, are you already getting any? Hearing any noise from individual investors in the trust at this stage about that kind of investing, or is it, at the moment, is it absent?
We do get the occasional letter from shareholders. We get the occasional questions at AGMs. I think at the moment they're mainly questions rather than wishes, but it's certainly a lively debate at the boardroom as well. The board want to understand our approach, and so time will tell. But at the moment, so far it's been a very modest number of shareholders who've actually mentioned it. But I think it's an issue that a lot of shareholders do think about quite a lot.
Okay, thank you. Which measures of cash flow do you use in taking your decisions to buy?
The main measure we look at is what we call free cash flow free cash flow yield. So we look at cash after a company has spent everything it needs to spend on investing in the business, on operations, obviously, on CapEx, so capital expenditure, but also interest costs, tax costs, and the cost of any regular investment to grow the business. And what's left is free cash. Now, the company can either use the free cash to pay to shareholders in dividends, they can use it to pay down debt, or they can use it to fund mergers and acquisitions, or really acquisitions. But that is a choice of the company. But that free cash is something that is surplus to what the company needs just to do its everyday business. And if, to give you a number, if a company can continue to invest in its business, grow its business, and generate, let's say, a 10% free cash flow yield, that means you as shareholders could theoretically take 10% a year out of the business without harming its investment prospects. And that's a lot. So, I mean, 10% free cash flow yield is a pretty high number, and you would normally expect that on companies that are not really growing. That's the one measure. We will then look at other measures, but free cash flow, comparing the free cash flow to the value of the company is the main measure we would use.
Okay, thank you.
And relate that to the growth as well.
Okay, yeah. M&G has a 9% yield at the moment, but you've sold it. What was the reason for that?
Very sharp eyes from one of the questions there. So it was indeed one of the companies we sold. We inherited a small position in M&G from the demerger of Prudential. And we don't really have a problem with the company, but we had a low conviction position. It does have a high yield, but it's a tough industry, asset management. I say that as an asset manager. It can be a challenging industry. So, we don't have a particularly optimistic view about M&G. We don't have a pessimistic view, but it was a small position. And as we found companies with higher conviction, we decided to sell it. I should say the way we approach investing is we don't own any companies in the portfolio that we don't have a positive investment case on. So it doesn't mean we have a negative investment case when we sell it. So we're not saying M&G with a 9% yield is expensive. I'm not saying that at all. What I'm saying is I don't have a really strong conviction view on it at the moment. And we had lots of other companies where we do have conviction. So we used it to fund. In this case, we were buying Admiral, which is another insurance company. Very well. M&G is not an insurance company, but has come from an insurance company. That's a very, very tenuous link. But Admiral is also a high yielding company where we have much higher conviction. So we used it to partly fund that. Okay.
What do you foresee as a trigger for the undervaluation of UK equities to reverse? Do you see any particular triggers?
Great question. And we were getting very excited in about late 19 as Brexit was. There was a lot of concern about Brexit, and it was starting to be. I wouldn't use the word done because that not really happened totally, but it was becoming less of an issue. I think the world. If we looked at the pessimistic forecast for the UK during Brexit, they've not really come to pass in terms of unemployment, in terms of the economy. And actually, for most British companies, it's really important to understand that 60 to 70% of the FTSE 100 and the large company earnings come from abroad. So Brexit was never a massive issue for the stock market, even if it was an issue for the economy. So we felt that people were starting to move on. Then we had the pandemic, and initially the UK was hit quite hard. And then we had the Ukraine invasion, which with the gas price spike, which is a European factor, but clearly impacts the UK as well. So there's been plenty of reasons for investors not to look at the UK for a long period of time. I think hopefully all of those are behind us, or well, the Ukraine war clearly isn't behind us, but the worst of the pressures might be behind us. And people can start to look again, and we're seeing, I think the low valuations of the UK are interesting. The strong performance of the UK as a market last year, I think, might start to be a catalyst for investors to look more closely at the UK, and that's really interesting. I think the other thing is M&A. We're seeing, because the UK is a very open market to investment and takeovers, we see from time to time foreign companies and actually British companies buying UK businesses. I think that will carry on. That stopped a little bit the second half of last year because interest rates were moving so fast and companies were so uncertain about things. So companies were uncertain what to do. Private equity couldn't really price deals because of the cost of debt. Private equity might take it a little bit of time to come back, but I think the corporate sector will come back. So corporate buyers, individual investors may well start to look at the UK again. And I think that will lead, hopefully, to the UK performing better. But it's a hard one to call because for the last 3 or 4 years, I've been a bit of a broken record on this. But I think there's a lot of opportunities in the UK.
Okay, thank you. Somebody points out that last year the slides show you swapped copper miners, I presume,
yes,
for something else. I don't know what, but what drove that particular decision?
So I'll try and share that again. So what the question is referring to, I think, if you can see that, is I'm not sure if you can see that or not, is a switch from Antofagasta to Atalaya.
All right. Yep.
Not sure if that's showing, but it doesn't matter.
Yes, it's showing. Well, it's showing on my screen anyway.
Good. So Antofagasta is a Chilean copper miner, a nice, good company. But the government at the time were talking about a massive increase in the royalties. I mean, we've seen something in the North Sea, but this is pretty draconian. And we were just a bit nervous that if that law came through, that would damage them. At the same time, we've been looking at a company called Atalaya, which operates, funnily enough, a mine called the Rio Tinto mine in Spain, which is the original Rio Tinto mine. It's been going for thousands of years, but there's still plenty of copper to get out of it. And it's a really interesting company. One of my colleagues went to see it on the ground. It's got some opportunity to grow the production. It's relatively high cost, so it's quite sensitive to the copper price, but it's also got opportunity to expand production and to bring the cost down by bringing in their own energy supplies and to high grade some of the copper coming out of it. Anyway, it's also in a low risk jurisdiction, Spain, very well. Clearly the rule of law is very strong in that area, which is not the case in all copper producing countries, shall we say. And therefore we were able to buy Atalaya. We like copper as an asset class or as a commodity. If you look at the decarbonisation needs of the world, we're going to need a lot of copper, both for renewable power generation, for transmission, for storage. Copper is pretty fundamental, and there isn't that much being produced. And sorry, it's very hard to bring on new copper supplies. Most of them are in very dangerous, difficult countries to get the copper out of. And actually, even then, there isn't that much to come through. So we see a demand-supply balance that's very favourable in the medium to long term. And therefore, if we can find copper exposure through Atalaya, to some extent through Rio Tinto, then we're quite interested in that.
Okay, thank you. Is a dividend always paid out of income, or do you make asset sales to top up the income?
Well, no, that's a very good question. The asset sales give capital gains. If capital gains do not count to the revenue reserves. So income has been paid out of either income in the year or revenue reserves, which is income that's built up in previous years into reserves, which the board can then pay out. The board does have the power to pay dividends out of capital, and it's an authority that's renewed every year at the AGM. It has not done that historically, certainly not in living memory, and has no plans to do that. But certainly it has the capability to do that should it be necessary. But at the moment, dividend has been paid out of either income in the year or income in previous years that's been put back into reserves. And just to be clear, reserves aren't held separately; they are invested in the portfolio.
Right.
It's an accounting reserve.
Yeah. A quick history question: what's behind the name Merchants?
Well, that's a good question, actually. I think originally the Merchants Trust was founded, and it was called Merchants at the time, to invest in specifically in international investments, so areas like railroads in America, bonds of railroad companies, Australian beer producing. I think because it was money that, I don't know, maybe because merchants were trading those assets or money that merchants put inside. I don't actually know where the name came from, but it was set up by Robert Benson in 1889, and Robert Benson ran it for 40 years. He was the founder of Benson, which became Climate Benson, and Climate Benson was taken over by Dresner, which got taken over by Allianz. So it's always been managed effectively by the same team through that connection, but under different ownership ultimately. But okay. I don't know. It's a good question. Okay. I mean, Ollie might know actually on the line
if Ollie's there. Are you there, Ollie?
I am, but I'm about on the same wavelength as Simon. I'm afraid I think I would go with the same explanation. Sounds about reasonable to me.
Okay, thank you. What drives your optimism on Admiral as opposed to other insurers at the moment?
Well, I'm not making a call on the other insurers, other car insurers. I mean, we own reinsurers like SCOR and Conduit and Swiss Re. On Admiral, we just see it's a very well-run business. It has a cost advantage over the industry, which has allowed it historically to make very high returns and also to reinsure a lot of its risk in a very favorable way. So its return on capital is excellent. It's grown because it has the lowest cost base in the industry. It's now the market leader. It has a cost base which is structurally lower because of where it's located and because of the way it runs the business. And the whole industry was under a cloud last year because insurance rates had been quite modest, and then claims inflation went up significantly. You've seen a big profit warning recently from Direct Line. The cost of claims has gone up for two reasons. One, because people are driving more than they were during the pandemic, but also because car prices have been firm. When you have an accident, it costs more to replace the car or repair the car. Actually, repair costs have gone up as well. So there's been a lot of claims inflation. So the industry was under pressure. Share prices were very weak. Gave us an opportunity to buy Admiral at a good time. We are now seeing inflation rates go up significantly, prices go up significantly for insurance, and that is helpful. So we just think Admiral's a very, very well run business. I'm not making a call on the other stocks. They may be cheap too, but that's where we see a good potential, and we think it can continue to pay its dividends, albeit the specials might be reduced for a while.
Okay, thank you. We're all out of questions from the audience. I've got one. Just to round off, actually, seeing as we've got a minute. If you had to pick on one or two things only out of your investment approach and process, what would differentiate you from your peer group, you think?
I think the main thing that is different on our value approach is the thinking about themes. It's about long-term structural trends. So it's very easy to find companies that look cheap, which you think are fundamentally strong, but you have to really understand why they might be value traps, where a value trap, as I said earlier, is where the intrinsic value of the business is declining every year. And so the shares always look cheap, but they keep going down. By thinking about what the long-term drivers of that industry, what are demographic themes, structural trends, we try to avoid the companies with value traps, and find those that have favorable demographics or favorable themes behind them. I think that has been a big differentiator. And then being willing to move the portfolio quite actively in and out of sectors. We had no tobacco in 2017. We had a lot of tobacco 2 years ago. So that willingness to be active and move the portfolio around to where we see value is also very important.
Okay, thank you, Simon. Well, I think that could wrap it up very nicely, bang on 5 o'clock. So thanks very much for your insight today. That's been extremely interesting and useful. And particularly those of us who are interested in a steady and reliable yield. So I hope we can perhaps catch up with you again next year. Wish you well with your investing and management of the portfolio over the coming 12 months. And
thank you very much.